Hello friends, welcome to Invest Surge English audiobook channels. Here's English summary of Chapter 16 from Technical Analysis of the Financial Markets by John J. Morphy. This chapter covers intermarket analysis, one of Morphy's most famous contributions, explaining how stocks, bonds, commodities, and currencies interact to shape overall market trends. Chapter 16 Intermarket Analysis. What is intermarket analysis? Every market is part of one global system. Stocks, bonds, commodities, and currencies don't move in isolation. They respond to one another through interest rates, inflation, and capital flows. Understanding these relationships helps traders see the bigger picture and confirm or question technical signals from individual charts. The four major markets. Intermarket analysis focuses on four key arenas. Commodity market represents inflation pressure. Bond market reflects interest rate expectations. Stock market shows corporate growth and confidence. Currency market expresses global capital flow and competitiveness. Changes in one usually lead or lag movements in another. Traditional relationships. Morphy's model. Morphy identified several repeating connections. Commodities, bonds. Rising commodity prices create inflation fears. Interest rates rise, bond prices fall. Bonds, stocks. Higher rates hurt business profits and investor confidence. Stocks eventually decline. Commodities, bonds, stocks. Falling inflation lowers interest rates. Bonds rise. Stock markets strengthen. US dollar commodities. A strong dollar makes commodities cheaper in dollar terms, pushing prices down. Role of the US dollar. The dollar sits at the center of Morphy's model. Because commodities are priced in dollars, currency swings drive global inflation. A falling dollar boosts commodities and inflation. A rising dollar cools them down and supports bonds. Thus, monitoring the dollar's trend gives early warnings about shifts in both inflation and equity trends. Bonds as a bridge market. The bond market links commodities and stocks. It's often the first to react to inflation or deflation signals. When yields start rising sharply, it's a red flag that inflation is picking up, a bearish sign for equities. Conversely, falling yields usually precede stock recoveries. Interest rates and inflation cycle. Morphy explains an economic chain. Commodity prices, inflation, interest rates, bond prices, stock prices. Each stage unfolds in sequence. Recognizing where the economy sits in this chain helps traders align with the macro trend. Practical use of intermarket analysis. Narrator. How can traders apply this knowledge? Use commodity trends to anticipate changes in bond yields. Use bond yields to forecast stock direction. Watch currency strength to confirm commodity moves. Example. If commodities fall, bonds rise, and the dollar strengthens, the environment favors stock market recovery. Global perspective. In today's connected world, intermarket analysis must include global markets. Japanese, European, and US indices often move together. A surge in oil or gold affects not only Wall Street but also Asian and European economies. Modern traders must think globally, not just locally. Limitations and warnings. Relationships can change during crisis or policy shifts. For instance, central bank interventions or quantitative easing can distort normal patterns. Therefore, intermarket analysis should complement, not replace, chart study and price action. Chapter 16 teaches that no market moves alone. By studying their interactions, commodities, bonds, currencies, and stocks, traders can spot turning points early and trade in harmony with the global cycle. Markets are like instruments in an orchestra, each has its own sound, but together they create the full symphony. Learn to listen to all of them, and your technical analysis becomes complete. Thank you friends, for listening this book. If you liked this audio, please like,